You're listening to Nora and Noah Decode the Day, where markets meet meaning every morning.
Welcome to the Deep Dive. Today we're looking at something that's definitely keeping people on their toes in the financial world. It's these shifting expectations around when the Federal Reserve might actually start cutting interest rates here in the U.S.
Yeah, it's been a moving target.
Totally. We've got some interesting insights from, recent market activities, specifically how traders are placing their bets.
Right, based on the latest economic news and, well, what they think the Fed might do next.
Exactly. So our mission today is to really try and understand why these expectations are changing, what the key drivers are, and, ultimately what it all might mean for you.
Sounds good.
And just to kick things off with something that kind of jumped out at me, the number of rate cuts traders expect this year. Well, it's actually gone down compared to just a month ago.
It has, yeah. It's quite a noticeable shift.
Okay, so let's unpack that. Why is that happening?
Well, it really is significant. If you think back to, say, the start of April, the general feeling, the market consensus, was pricing in 4 quarter-point reductions.
4 cuts this year. Okay.
4 cuts, yeah. But now, as we're heading towards the Fed's next big policy meeting, that number's dropped down to 3.
Only 3 now.
Only 3. And it's not just fewer cuts, but the market's also predicting the first cut will happen later than they thought before.
Right. So the timing's pushed back, too. It feels like the market kind of did a quick U-turn on those earlier, maybe more optimistic rate cut hopes.
It does feel a bit like that.
But what I also found really interesting in the notes was while the hopes for this year have cooled off a bit, the outlook further down the road seems to be, heating up.
Exactly. That's a great way to put it. If we zoom out a little, look further ahead, the market is now pricing in about 0.5 percentage point of additional easing in 2026.
0.5% more in 2026.
Wow. Yeah, and what's really notable there is that this is the most aggressive level of cuts anticipated for 2026 that we've actually seen so far in this whole easing cycle discussion.
So the belief that rates will come down eventually is still there. It's just...
Right. It's just the timeline, exactly. Yeah. It seems the focus, or maybe the bulk of the expected cuts, has shifted a bit further into the future.
Okay, so what's causing this change of heart? What's making the market rethink those 4 cuts this year and look more towards 2026?
Well, a really major factor appears to be the U.S. economy just being, surprisingly strong, resilient.
We keep getting these data points that seem pretty good.
We do. We've had a string of releases recently that have, consistently beaten what economists were forecasting.
Like that jobs report we saw not long ago, right? That one really seemed to grab a lot of attention.
Precisely. That jobs report. The employment numbers were significantly stronger than anyone really anticipated.
Yeah.
And that had an immediate, very direct impact on expectations for a June rate cut.
Yeah.
The thinking is pretty straightforward, really.
If the job market's healthy,
then the Fed doesn't need to rush in and lower borrowing costs to stimulate things.
Right. It makes sense. If people are working and the economy seems okay, less urgency for the Fed to cut rates.
Exactly. And it wasn't just the jobs data either. There was the April report on the services sector from the ISM.
Okay, the Institute for Supply Management.
Yeah, that also pointed towards continued economic strength.
Yeah.
And that just added more pressure on short-term Treasury yields.
Which are always sensitive to rate expectations.
Very sensitive, yeah.
Oh.
Especially those near-term expectations.
Oh. So it's this combo of positive signals making the market think, okay, the Fed can probably wait a bit longer. We even have that quote here from Kevin Flanagan at Wisdom Tree.
Oh, yes.
He basically says, unless something bad happens between now and June, it means the Fed doesn't need to go. Pretty blunt.
It is. And it really highlights that key part of the Fed's job, their dual mandate, maximum employment and stable prices.
Right.
When employment looks strong, it gives them more breathing room to focus on the other side, inflation.
Okay.
And as Flanagan points out, when the incoming data starts to look different from what the Fed maybe suggested earlier.
Like their March forecast, which I think mentioned 2 cuts.
Exactly. When data diverges from that, then short-term yields, they get more volatile. People readjust their bets.
Which naturally leads us right to the Federal Reserve itself. Their upcoming policy decision is obviously huge. Everyone's waiting.
Absolutely. All eyes on that, and particularly on what Fed Chair Jerome Powell says afterwards.
Yeah, the press conference. What are traders listening for there?
Well, they'll be parsing every word, looking for any clues, any signals about how potential economics policies might factor in
You mean like the talk about President Trump and potential tariffs?
That's a big one, yes. The possibility of higher U.S. tariffs and how that might influence the Fed's thinking on the timing of any rate cuts.
So the worry is that tariffs could what? Push inflation back up?
That's the concern, yeah.
Yeah.
It's definitely on people's minds. Before the Fed went into its quiet period, their pre-decision blackout, we heard from several officials calling for patience. The worry is that higher tariffs could mean higher prices for consumers, which complicates things for the Fed.
Yeah, complicates the decision on when to start easing policy, when to cut rates.
It makes that balancing act even trickier.
Okay, so it sounds like the Fed's walking a tightrope. Still solid economy on one side, potential future inflation risks on the other. No wonder market expectations are jumping around.
Precisely.
Now, the information we have also gets into how traders are actually reacting, adjusting their positions in the market. What can we learn from what they're doing?
Well, that fading expectation of a June rate cut, especially after that strong jobs report we mentioned, that really triggered some significant moves. The notes describe a considerable amount of deleveraging and position unwinds.
Okay, deleveraging and unwinds in plain English.
Right. Basically, traders who had bet on short-term rates falling soon started closing those bets out. They were liquidating those long positions.
So taking their chips off the table for quick cuts?
Pretty much. They were saying, okay, maybe those cuts aren't happening quite as fast as we thought, reducing their risk on that specific outcome.
Got it. So closing out old bets, are they making new ones that tell us something?
Yes, and we're also seeing shifts in the options markets that suggest a belief in a more, let's say, gradual approach from the Fed.
How so?
Well, there was one specific, quite large options position mentioned. It was designed to hedge against, really deep and fast rate cuts.
Okay, protection against big cuts.
Exactly. And the expiration date on that position, it was recently extended for the second time.
So pushing the protection further out in time.
Right. It suggests that whoever holds that position now thinks the Fed won't be in a massive rush to make large rate reductions anytime soon. They're betting on a slower pace.
That sounds like doubling down on the idea of a slow, steady Fed.
It does lean that way, yes. But what's interesting is that in the actual cash market for treasuries, the conviction seems maybe a little less strong.
Oh, why is that?
Well, investors are still grappling with those uncertainties. We talked about Trump's potential trade policies, how the Fed might react to them down the line.
Still weighing things up.
Exactly. And the J.P. Morgan Treasury Client Survey kind of reflects this. It showed that neutral positions, basically, not making a strong bet either way on rates.
Just sitting on the sidelines? Sort of.
Sort of, yeah. That neutral stance remained at a relatively high level.
So a lot of investors are still in wait-and-see mode, trying to figure out how all these pieces fit together.
Seems that way, yes.
Now, the data we have also gives us a snapshot of positioning up to May 5th. Any key moves in that specific week?
In that week, yes. J.P. Morgan's clients did nudge up their long positions slightly.
Meaning they were betting bond prices would go up, yields down.
Correct. A slightly more bullish bet on bonds. And this increase came mainly from people shifting out of those neutral positions.
Okay, so a bit less sitting on the fence that week.
A little bit, but, overall long positions only hit a 3-week high, and neutral was still the most elevated stance. So maybe call it cautious optimism.
Cautious optimism, that definitely feels like the theme here, doesn't it?
It really does.
Okay, now let's tackle options market skews. That sounds a bit technical. Can you break that down for us? What does skew tell us?
Sure. Option skew basically tells us about the relative price of betting on rates going up versus betting on rates going down.
Okay. The cost of protection, kind of?
Exactly. It gives us a sense of which direction traders are more worried about and therefore willing to pay a bit more to insure against.
Got it.
So in the case of long-term treasury bonds, the long bond futures, the skew favored puts.
Puts. That's a bet that prices will fall, right? So rates will rise.
Correct. Think of a put as insurance against prices falling or yields rising. So the fact that puts were relatively more expensive suggests traders were more concerned about a potential sell-off in long-term bonds. They were hedging against long-term rates going up.
Interesting. So more worried about long-term rates rising than falling.
That's what the skew implies for the long end, yes. But here's the contrast. When you look at shorter and intermediate term treasuries.
Like 2-year, 5-year, 10-year notes.
Exactly. There, the skew favored calls.
And calls pay out if prices rise, meaning rates fall.
Right. So for the shorter end of the curve, traders seemed more inclined to hedge against rates going down or a rally in those bonds.
Huh. So worried about rates going up at the long end, but potentially down at the short end.
That's the picture the skew paints. And this difference is actually reflected in the shape of the yield curve itself. It got steeper.
Meaning the gap between long-term and short-term rates widened.
Yes. Specifically, the note mentions the spread between 5-year and 30-year yields widened to its highest point since, October 2021.
Okay, interesting. So the market's bracing for potentially different moves across the curve. Now, finally, let's look at this CFTC data on leverage and duration positioning. What are the big players doing, asset managers, hedge funds?
Right. The CFTC data gives us a peek into how different investor types are positioned in the futures market. And the data up to April 29th showed a pretty noticeable split.
A split between who?
Between asset managers and hedge funds in their Treasury futures bets. Asset managers think big pension funds, mutual funds, often with a longer-term view. They've been consistently increasing their net long duration position for 8 weeks running, actually.
Okay, long duration means their betting rates will eventually fall, boosting bond prices.
That's the general idea, yes. They're positioning for lower rates down the line.
Okay, so the big, maybe more traditional players are leaning toward lower rates. What about the hedge funds?
Well, hedge funds, which often use more active, sometimes shorter-term strategies, they've been doing the opposite.
Going short.
Increasing their net short duration positions over the past 5 weeks. So they're betting that rates will go up, pushing bond prices down.
Wow, so we have these two major groups taking basically opposite views on where rates are headed.
Exactly, a real divergence there. And interestingly, the notes highlight that the biggest moves in the latest week were in the 5-year Treasury notes.
The 5-year again?
Yeah. Both asset managers added significantly to their long positions there, and hedge funds added significantly to their short positions in the 5-year. So a lot of action and disagreement concentrated right in that middle part of the curve.
Okay, fascinating. So it sounds like there's a real difference of opinion playing out, especially around that 5-year mark. All right, let's try and pull all of this together then. What's the main takeaway from this deep dive into market expectations?
I think the central takeaway really is that the market has significantly dialed back its expectations for Fed rate cuts in the near term.
Fewer cuts this year?
Fewer cuts this year, starting later. The market now anticipates a more patient Federal Reserve.
And that's mainly because?
Mainly driven by the U.S. economy just holding up better than expected.
Yeah.
That resilience is key. Plus, you have this background worry about potential renewed inflation, maybe from tariffs, which also argues for Fed caution.
Okay.
So as a result, the expectation is now that the bulk of any further monetary easing, any more significant rate cuts, is probably pushed out into 2026.
Oh. Right. So bringing it back to the listener, what does this shift really mean for you in practical terms? Why should you care?
Well, this kind of shift in rate expectations can ripple out pretty broadly. It can influence the cost of borrowing money. Think mortgages, car loans, business loans.
Higher for longer potentially affects those?
Exactly. It can also affect investment strategies. Investors might adjust their portfolios if they think interest rates are going to stay higher for longer in the near term than they previously assumed.
Definitely something for you to keep an eye on. Okay, so here's a final thought for you to chew on. Given the strong economy, the Fed's cautious stance, and how these market expectations keep evolving, what happens if inflation does turn out to be stickier than people think right now? What if it proves more persistent, maybe even hangs around well into 2026? What might the longer-term consequences be then? It's a crucial question, I think, as we navigate these pretty dynamic times. Thanks for joining us for this deep dive.
That's it for today's Decode. If you found this helpful, make sure to subscribe, and we'll catch you tomorrow, right here on Nora and Noah Decode the Day.